What's up, guys? Welcome back to my personal finance channel. My name is Kyle DePepe, and today I'm actually going to be doing something a little bit different. You see, I've kind of gone down the rabbit hole of watching a lot of, other financial videos, whether it's from Graham Stephan, the Iced Coffee Hour with Jack and Graham Stephan, Andre Jick, Chandler Smith, Meet Kevin, and a couple others. After going down the rabbit hole of all of these different, financial related or investment type or personal finance, if you will, related YouTubers and YouTube videos, I found this one that's just on Jack talking about options, which I absolutely love. I will talk about options all day and night. If anybody wants to learn about them, I will teach people all day. That's part of why I started this channel, even though those few videos that I put out on buying, selling, puts and calls and stuff like that didn't do that great. Either way, it's just a passion of mine. So I thought I would do a reaction video to this. And if you guys want to talk about it, Jack, you more specifically, I would love to come on the Iced Coffee Hour and talk more about options. I did prop trading for about 2.5 years. I taught options to myself in college. There's a whole story behind that. But I'm no expert. I also don't think you're an expert. I think I'm just constantly learning and evolving every day. But I feel as though I have a very strong grasp on options, trading them, whatnot, sort of supplementing trading strategies using options similar to what you've been doing. But either way, I guess let's just dive into it. So off the bat, I would say that you did a great job explaining options, like a general overview.
One option is a contract between two people that gives the parties the option to either buy or sell 100 shares of an agreed upon stock at a specified date in the future at a specified price.
How they work, all that jazz. So I'm not really gonna waste too much time there. Ooh, real quick, if you guys are enjoying the content, please hit that like button and subscribe to the channel. It would really help me out, would really appreciate it. And well, as Graham always says, be sure to destroy that like button because it helps out with the YouTube algorithm. Either way, let's get on with it. Now, the next thing I would touch on is you say you are a 10 out of 10, and then Graham mentions one that you might be potentially down on right now.
Didn't you tell me that you were maybe gonna lose one?
I did tell you that, and that's because I bought an option.
So you're not counting that in the statistic?
I am, but the option is not, it has not expired yet.
So this is like, I haven't lost money until I sell.
No, but yes, a paper loss is not a loss yet. So stick with it. Hopefully you get back into the green. Another way to think about this is that if you're doing these options, the options trading strategies that you are, they're pretty much all going to be short-term capital gains. And because of that, if you have some losses along the way, it's not a big deal, because at least you can offset some of those gains later on. So think about it that way. You don't have to be 10 out of 10 correct. Perfect track record is nice, but not the end all be all. Don't focus on that and let it detract you from moving on to the next investment. So I also do like the little clip of why options, why not just invest in stocks?
Why options trade and not just invest like I recommend?
Because if you options trade, you have a lot more choices, right? You have more options. If you're buying options, you have assessed risk, so you know exactly how much the maximum amount you can lose is. But if you're selling options, you have a guaranteed amount of money that you're getting, which is the premium.
And I also like the perspective of it sort of either gives you leverage or gives you, I guess I wouldn't necessarily say more control, but it gives you more options, right? So if you already own the stock, then you can sell calls against that position that you already own. It's sort of riskless extra cash generation. Riskless in the sense that you're not risking any more money, but you're, capping your upside. If you buy deep in the money calls, then you're getting sort of a one-for-one movement with the stock, but you're able to pay actually a little bit less. So I've actually done this recently in my Roth IRA. Instead of buying the stock, I get a little bit more leverage because, for example, if a stock's trading at $10, right, I can buy in the money calls, $5 strike, which means they're already in the money by 5 points. So 5 points of premium that I'm paying are already intrinsic value on that options contract. So because of that, those 5 points will always be there as long as it's trading above $10, right? As it goes up, there's more intrinsic value. And then there's a little bit of time premium, volatility premium, whatever it is. So for example, if I wanted to buy, let's say a stock's trading at $10 a share, and I want to buy the $5 strike call 1 year out, I might pay $7 for that, right? So $5 strike, there's $5 of intrinsic value, and I might pay a $2 premium on that call option. So I might pay $7. So that's obviously $700, so you have to multiply by 100. So I'm gonna pay $700 for one options contract. Now, if I went out into the open market, I would have to pay $1,000 to buy 100 shares, right? So same exposure, so the upside is still, 100 shares, but I'm paying $700 instead of $1,000. So what this means is, if I wanted to buy 200 shares, if I just buy the stock, I'm paying $2,000. But if I wanted to buy 200 shares worth using options, I would only pay $1,400, which means I could then buy another contract, 3 contracts, representing roughly 300 shares. So now I have the leverage of 300 shares and I'm paying $2,100. So I'm paying almost the exact same as if I bought 200 shares in the open market, but I can buy 3 options contracts. So I get the extra exposure of 100 shares by buying those $5 strike call options versus just buying the stock. So then this also sort of feeds into Graham's perspective of, well, why not just buy the stock? Why buy options? Well, because by buying in the money calls at a strike price that isn't 0, you're spending a little bit less than you would just buying the stock outright. So by doing that, you can get more leverage and more upside exposure to this stock. So if it doubles or triples in price, that $2 premium suddenly becomes negligible, but you now basically have control of an extra 100 shares, whereas if you put $2,000 to work just in the open market buying stock, you can only buy 200 shares. Your downside risk is exactly the same, right? If you buy the stock and you buy 200 shares for $2,000, your max risk is $2,000. If you buy the call options and you buy 3 call options, you have the upside exposure of 300 shares because you have 3 contracts, but your downside risk is still exactly the same. It's a little bit more, $2,100 because it's $700. But you get the point, right? You're basically risking 2,000 and 2,000, but with the call options, you get exposure to 300 shares. So therefore, it's actually less risky. Well, I guess I wouldn't say less risky, but the risk reward profile is so much better by buying those the in the money call options. And then something that I can really relate to is, you said you started options by selling puts.
How I got started in options trading was I was selling puts.
That's exactly how I started options too. I thought that was great. Now, obviously it was all cash backed, so I never sold naked puts or naked calls. I still never will. I actually started doing it on biotech companies because they had greater implied volatility around PDUFA dates, which is basically when they have a meeting where their drug gets approved or denied. So based on that alone, their stock can either skyrocket or collapse in value, which therefore bumps up premiums. So you're getting, like, I don't know, in some cases it would be 20% or more in 1 month selling out of the money puts against that biotech stock. So I wouldn't recommend it. However, it's what I started doing. I did get assigned on one, and I did have to hold that biotech stock. I actually held it for, I think, 2 years before they actually went back up and I made money on the stock too. So I kind of stuck in there. However, a lot of times with biotech companies, it's like a binary scale. They either get approved with the drug or they don't, and they either sell whatever they have left or go bankrupt. So it is we won't get too far into that either, but there are risks. So basically what I'll say is that right now it's very easy to sell puts and always be profitable 10 out of 10 times, in the sense that the market's basically just going up. And I think later on in the video you and Graham, you sort of touch on the fact that you started doing this right at the end of March, which is kind of the bottom of that dip when we started going higher. And I think you say that it's not a directional thing, but
my options weren't really directional.
Selling puts is extremely directional, right? It's not going down, but it's either staying flat or going up, right? So those are the 2 directions, going flat or going up. So if stocks are just going up in this market, if you look at the majority of stocks out there, the S&P 500, NASDAQ, Russell 2000, Dow 30, whatever it is, all of them from the end of March until the end of the year, or whenever the iced coffee hour, that film was at, I think September, October, stocks pretty much went up. And if you're selling puts, you're probably going to be 10 out of 10 on almost all of them, unless you happen to pick the one stock that was going down when everything else was going up, maybe like oil companies in the beginning. But either way, the point is, if stocks are staying flat or going up, you're going to make money, I guess, on selling those puts, because you're never going to get assigned, right? So I wouldn't say that it's not directional. I would say that it's extremely directional, whereas if you are in a bull market, then selling puts, you're generating income until one of those companies collapses and you get assigned, or if there's bankruptcy and it goes to zero, or it's a fraud and it goes to zero, then you're just bag holding.
You know how like when you say you're doing options, like there's kind of a stigma around it, like you're doing really risky investments? You are if you're buying, in my opinion.
So in that clip, you just said, I don't buy options. You think it's very risky and you just sell options. So let's just sort of unpackage this for a second. Buying options, it is risky in the sense that if you're buying out of the money options, you may never, see the stock go above that strike price. However, it's also not very risky in the sense that you know exactly what you're risking. If you buy an option, the amount that you pay for it is the amount that you're risking. So in that sense, you know your risk up front. It's capped. It's completely capped. Now, if you go to selling, right, even if you have a cash-backed put, you're basically risking 100 shares of that stock going to zero, right? So it's actually more risky than probably buying out of the money calls. Now, are the chances that the stock goes to zero high? Probably not. But in theory, it could be more risky. So let's just take an example of a stock trading at $10 a share. If a stock is trading at $10 a share and you buy out of the money calls, let's say you buy the $15 calls and you spend $5 on them, your max risk is $500. $5 times 100 shares, $500. So you're risking $500. That's it. You can't lose more than $500, right? Now, if you were looking at the stock anyways and it's trading at 10 and you're like, well, I'm gonna sell puts at the $9 strike. Well, you're risking $900 because the stock could in theory go all the way to zero. So your max risk there is $900 minus the premium that you can sell it for. So if you can sell the $9 strikes for $5, then you're only risking $400, right? Because 9 minus 5, you get to a $4 average cost. If you buy 100 shares at $4, it's $400. So it's definitely not as black and white as it's less risky, because by buying an option, whether it's a put or a call, you know your exact max loss. Whereas if you sell, as long as you're not doing naked sales, either cash backed or you have the underlying security for calls, yes, you know what your limits are there too, right? Like you're capping your upside gain, or you're I guess capping what your max loss is if the stock were to go to zero. But those are all considerations that you have to take into account. I guess I would disagree with you saying that buying calls or buying puts, either way, is more risky. I would say in some ways they're actually less risky, or just as much risk, because you know how much you could potentially lose. Same with if you had a cashback put or underlying security backed selling call. You know your max loss there in all those situations. So again, I wouldn't say they're any more risky in that sense. Now, you mentioned that you love these short strangles.
The short strangles. Let me explain to you why they are good, why I like them. If the stock goes up and you're forced to sell 100 shares of that stock, right? Because if it's a covered call, if it goes up, you're forced to sell at a lower price than what it is. You're gonna have the premium you collect from the call and the premium you collect from the put to offset that. If it goes down, and you're forced to buy from selling the put, you're forced to buy, you have the premium from the call and the put that you have to offset.
So again, this kind of goes back to, are you doing naked short strangles? Because if you are, please stop. And the reason I say this is that if you are selling a naked call, you say that basically the premium you're collecting from selling the put and selling the call, that's sort of your helping to pad those losses to the up or downside. Now, obviously on the downside, a stock can only go to zero. But on the upside, it could double, triple, quadruple. I mean, look at Tesla. Tesla's just, it's been insane, right? Now also you have to think about a stock could get bought out, right? A company could announce a buyout overnight, and that stock gets bought out for 2 or 3 times the price it's trading at. Now, I can almost guarantee that the options premium that you're collecting by selling a put and selling a call does not cover that much of a price change. So if that's the case, if that happens just one time, it's going to not only wipe out probably all the gains you've made, but you're probably going to owe a lot of money to Robinhood or whatever it is or you're gonna, your margin account's gonna get called. Whatever that scenario is, it's not gonna be pretty. It's not gonna be fun. And I really stress, don't trade naked selling call options. It's just it's not good. Just don't do it. You have unlimited risk. So going back to you saying that buying options is more risky, no, the most risky thing you can probably do is selling naked call options. It's the exact same thing as shorting a stock. If you don't have the capital to cover yourself, or a ton of funds, you have a ton of upside risk. So if you're doing 5 contracts and the stock goes from 10 to 100, I mean, you're getting your face ripped off in that trade. So I would highly advise, do not do those short strangles, especially if you don't have the underlying stock if you're not holding it, just because that upside risk of selling that call option is just really bad. Really bad.
Know that I am the options master.
The options master. All right. So based on, me sort of having disagreements with some of the things you're saying, I think you have a great understanding of options. But I think that there's a lot more to learn and situations that you haven't seen, right? You've been basically selling puts or doing these short strangles even in a bull market. When you're selling puts in a bull market, you're almost never going to get assigned, right? All these stocks are just going up and up because the Fed is just pumping out money, and the government's just handing out stimulus checks. And what are people doing? They're buying stocks. They're investing in the stock market. So when stocks are doing well, selling puts is a great strategy. Hey, bud. However, once the market turns and you get assigned one of these stocks that then collapses in half because the valuation just isn't there to hold it up, you've just lost half of your money that you then got assigned on this put that you were selling. Even if you thought, that was a decent price, it could still get cut in half from there, and then you've lost half of that total money of buying stuff. Either way, I think there's a lot more to learn. I think it's fantastic that you are learning options, because options are a great way to supplement just normal trading strategies. There's a time and place for them, and I absolutely love option strategies. I employ them all the time, especially my Roth IRA, because I don't have to pay any capital gains tax on any of those things. So I use options all the time in my Roth IRA, especially for YOLO kind of call things. But yeah, they're fantastic, and I definitely say keep learning more. I've definitely lost a good amount of money with options, but I personally like to buy options more because the upside is so great, and your exact risk. So for me, buying options is honestly the less risky strategy, right? So there are different ways to look at it, and I think, going back to the options master thing, there's more to learn, or more sort of strategies that you could potentially employ. So again, I would say, if you guys want to have me on Dice Coffee Hour, I would love to. I love talking about options. Absolutely love it. Love it. See the hand movements? That's how much I love it. And you mentioned the theta gang. So theta is basically the time value in options. I don't pay too much attention to a lot of the Greeks and deltas. I just look at sort of the price, where I think the price is going to go, what's the risk reward, how much money can I make in a trade, how much money am I risking in a trade. So you can use all the Greek things for that, but theta is basically time value. So that's like premium. So when you're selling, calls or puts, theta, the higher the theta, the more time value there is. So that basically just goes to, if you sell an options contract that expires in a month versus one that expires in a year, you're going to get more premium for that one in a year, because there's more theta, there's more time value or time premium in that options contract. So theta gang, they like to sell that time value, collect premium on it, and that's how they play that. So you can sort of look at different lengths of contracts in order to get more premium potentially for them. So theta gang does that, and obviously again, like I said, you're capping your gains, right? Exactly how much you're going to make on this trade. You're going to make whatever you sell that option for. However, your max loss is potentially a lot more than that gain. So that's where, especially with selling puts, now if you sell calls, your max loss, I guess, is just that you're missing out, or you're losing out on the opportunity of the upside on the stock. The last thing I'll say is, you guys mentioned a YOLO play for Graham, looking at Snow, that IPO.
Graham said he was willing to YOLO some money into the market, $1,000.
They're going to pick something crazy that's going to lose money. I really want to do the Snowflake IPO. I really want to buy calls on that.
Options, I mean, there's obviously no way to buy a stock, let alone options, because options are just a derivative of the underlying. So if the stock isn't trading, there's obviously no options yet. So until the stock actually IPOs and starts trading, there obviously won't be any options, because options are a derivative of the stock. So either way, options also don't start trading, I think, until at least a week. So a week has to go by before there will be options on that stock. So even if there is an IPO, you can't trade options around it until I think it's at least a week. Not 100% on that, but you could probably just Google it. But either way, yeah, so if you're ever looking to trade options around an IPO, you can't. You just have to buy the IPO if you want to buy it. But that's a whole different ball game. So won't get into that. But either way, fantastic iced coffee hour. I love talking about this stuff. I would love to come on and talk to you guys. If you're interested, hit me up. But either way, that's going to be it for this video. Hope you guys enjoyed it. If you have any questions, comments, concerns, leave them in the comments down below. I would love to hear from you guys. If you guys want to know more about options, I'll try to make more videos. I made some, so go check them out if you want to. But I feel like it's easier to have a conversation where you can sort of address questions and it makes more sense. So either way, that's going to be it for this video. Be sure to smash that like button and hit subscribe if you haven't already. And until next time, guys, thanks for watching.